So if you watch the examples, we talked about how as the interest rate in the market changes, as the yield changes, the relative value of the bond is also going to change. And this describes one of the two fundamental rules of finance. Right? There are just two things that you should absolutely take away from this class. There are potentially things that you could be asked in an interview, and one of them is described by this dynamics and this relationship, which is that prices and interest rates move in opposite directions. They have what's called an inverse relationship. Okay, so we saw that if interest rates, market rates go down and go down relative to the coupon rate, prices of the existing bonds rise, and they rise above the par value, which is $1,000. And those bonds are now said to be selling at a premium because the price is greater than the par value. And as interest rates in the market go up relative to the existing coupon rates, then prices of those existing bonds fall below the discount, below the par value of $1,000, and those are said to now be selling at a discount. Okay, so this relationship is basically the fundamental relationship describing the value of a bond. Okay, but it also is a fundamental relationship that describes the value of any type of debt, and which is a huge part of the financial world, which is why it's such a fundamental rule. Okay, and we can see that play out here again graphically. Hopefully our other slides made it more clear, but here's another graphical example of this relationship, right? And it's what we call interest rate risk. Now there's two bonds graphed here, one in green, which is a 30-year bond, and one in blue, which is a 1-year bond. And what we can see here on the y-axis is the bond's value. So this is the present value of the bond's future cash flows, which are the coupon payments and the face value being returned. Both of these are standard $1,000 bonds. And what you can see on the x-axis is the interest rate, right? So when the bonds were issued, the interest rate was 10%, so the coupon rate was chosen to be 10% as well. So at a 10% interest rate, both of these bonds are worth $1,000. But as the interest rate in the market changes, the value of these bonds change. And they change because the other options, the value of the other options change. Okay, so if we just look at the 1-year bond, we can see that if the interest rate doubles to 20% in the market, the value of this existing bond decreases by almost $100 to $916. And it does that precisely because the other options in the market are now offering 20%. And so the only way for me to be able to sell my existing bond that pays 10% is to offer it at a discount. We can see that that's even more significant on a 30-year bond because the value of a 30-year bond is nearly cut in half when the interest rate doubles. It is dropped down to $500. And the difference between those is all due to the maturity. Right? A 1-year bond only has 2 coupon payments, right? If it's semi-annual, and most bonds are semi-annual. So that means that if the interest rate doubles and you are the owner of a 1-year bond with now a 10% interest rate when all other 1-year bonds have a 20% interest rate, you're not going to be missing out on that much additional interest because you only have to hold the bond for a year. So there's only 2 coupon payments that are going to be not as good as what you could have been earning. But if you're the holder of a 30-year bond, you're now locked in for 30 years to a rate that is considerably lower than what exists in the market. And if that rate doesn't change, then you're going to be worse off for a long time. Okay. So the length of time compounds the rate of the interest rate risk. And you'll find that that's basically true across any kind of risk, that the longer time you have until this contract matures, the greater the risk is going to be. And we can see that the opposite is true. If the rate falls, then prices on both rise, but the price on the 30-year bond rises even faster than the price on the 1-year bond for precisely the same reason, because you have 30 years of interest payments to collect at 10% when everybody else is only earning 5% on new bonds. Okay, So just some sort of wrap-up comments here. Here's the formula for the bond, the value of a bond, if you want to see what the calculator is actually doing. This first part is the present value of an annuity, and you can go back to the earlier lectures and check that out. C is the cash flow, and then the present value function there. And then plus the present value of the face value, which is the amount of the loan that you get paid back at the end in the future. That is the present value of a bond. Okay. So that's the formula. Again, I don't expect anybody to be using it. This is all done based on the calculator like you just saw. And there are very little differences to what we've done before. Semi-annual coupon payments, we'll jump here, we'll work an example so that we can convert, see how a bond with semi-annual coupons payments is made. Most US government bonds pay coupon payments twice a year. Lots of corporate bonds pay coupon payments twice a year. So this is super common. It's probably the most common payment structure for bonds. Of course, we have already seen in previous problems how to adjust our time value of money problems so that we can have different periodic payment structures. The important part here is that we identify the correct compounding period, and then we adjust all the other inputs to be at a semi-annual compounding period instead of an annual one. Otherwise, we don't have any other difficulties here. Okay, so jump out, watch a couple more examples here. Okay, welcome back. We want to talk a little bit more about yields because the word yield is used a lot in finance, and it is not always referring to the same thing. Okay, so we want to make two distinctions definitely within this class. One is that there is a ratio that is very common that is called the current yield. And the current yield is the coupon payment divided by the current present value, the price of the bond. Okay? So this is a ratio. It is describing the yield of the bond based on its current price. The yield to maturity is the rate of return based on the bond's current price. It is not a ratio. We have solved for the rate. It is determined by the maturity of the remaining maturity of the bonds and the current price of the bonds. Okay, so yield, typically, if someone just says yield, they're referring to the yield to maturity. However, it is common to hear people say yield a lot. They will say things like this investment is supposed to yield this or yield that. The word yield usually is just referring to the fact that this is the rate that you're going to get, right? And it comes from this bond space. Originally, it comes from the bond space, so this is where the terminology originated. But it has sort of expanded to be anything else. So when someone is talking about what an investment is yielding, what they're talking about is the rate of return that you're going to earn if you buy into the investment right now, right? So with bonds, that has a very specific meaning. It's the yield to maturity. With anything else, it is a more ambiguous meaning simply about the rate of return that you should expect if you invest in whatever they're offering, okay? So distinguish here in the bond space specifically between the current yield and the yield to maturity.